Every successful business runs on a sort of rhythm of buying and paying. Behind the scenes, that rhythm is powered by the procure to pay process. From the moment a company identifies a need to the final payment to a supplier, procure to pay ensures efficiency, compliance, and strong supplier relationships. In this video, we'll walk through each step of the process: procurement, approvals, purchase orders, receiving goods, and payment, so that you can see how organizations use this process to operate efficiently and effectively. Merchandising companies, like our textbook example, max out sporting goods, purchase goods for resale, and therefore have additional expenses that are called cost of goods sold. When we subtract these cost of goods sold from the sales revenue, we arrive at gross profit and the gross profit percentage. This is a very important number because it tells us how sustainable this business is, because the gross profit needs to be large enough to pay for all other expenses and still leave enough profit for the owner to draw money out of the business. Keep in mind that there are businesses that provide both goods as well as services to their customers. For instance, a company like Costco primarily resells goods, but also offers installation services. Or, for instance, Kaiser Permanente, a business I work for, primarily provides medical and insurance services, but also buys and sells pharmaceuticals. The operating cycle of a merchandising company starts with the purchase of products. We'll talk about how the purchasing process works, including purchase requisitions and purchase orders. Next, the merchandise inventory is received and stored for sale. We'll talk about controls that companies should have over this merchandise inventory and the inventory systems that companies use, the perpetual and the periodic inventory systems. The merchandise inventory is sold for cash or on credit, and credit sales create accounts receivable. The business needs good processes and a good credit policy to manage these receivables. Customers will eventually pay, hopefully timely, and the company collects the cash, which in turn is used again to purchase merchandise. Every step along the way, the company should have safeguards in place that prevent fraud and loss of products. Remember, thieves are very creative and adept at finding loopholes and gaps in the process. In my accounting ethics class, we talk about one such example involving Rite Aid and one of their VPs who was tasked with selling an inventory surplus, which she claimed to have sold for a low amount to a company which was really an accomplice in this case, when in fact the surplus inventory was sold to a third party for a higher price. Rite Aid's VP collected a kickback from the accomplice of nearly $15 million in this fraud case that lasted for nearly 10 years. So every step in the process should have internal controls, and no one person should be able to handle multiple steps in the process on their own. If the company is small and it's not possible to hire additional personnel, then there should be compensating controls, meaning somebody regularly double checks the work, such as random checks of purchase orders, invoices, review of bank statements, and payments. The first step in the operating cycle is the purchasing step. Merchandising companies purchase goods for resale and must have good operational and accounting processes in place to ensure that only an authorized person places the order, that vendors are pre-approved, that the goods are received by someone else other than the person who ordered, and that the accounting department compares the order to the receiving document and with the invoice from the vendor. The entire process from ordering to paying the invoice is called the procure to pay or P2P process, and the matching of the order to the receiver to the invoice is the three-way match. A large firm usually has a centralized purchasing department that is responsible for locating suppliers, obtaining price quotations, negotiating credit terms, and placing orders. For instance, when I worked for Kaiser Permanente as the pharmacy controller, I saw firsthand how much effort goes into procuring medication, medical, and other supplies. Sometimes prices changed monthly, and the purchasing team was on constant alert to source effectively and efficiently because, after all, companies can't immediately change the price customers pay when suppliers increase their prices. In small firms, purchasing activities are handled by a single individual, usually the owner or manager. Most merchandising companies buy on terms or open account arrangements. That means that they receive the goods and the invoice but don't have to pay until later, often 30 days. Purchasing is one of those areas where fraud and theft can easily occur. And that is why auditors focus on this area, and companies should protect themselves from fraud and theft by having different employees assigned to different parts of the process, and there should always be a good review process. The procure to pay or P2P process starts with the need to order product. In large companies, the inventory management system might show that product inventory is low for an item and the product needs to be replenished. In small companies, the owner may review the warehouse inventory and decide that a product needs to be reordered. In one small company I worked many years ago, the owner had a report of how many items sold over the past 30 days, past 90 days, and past year, and then would walk the warehouse and check how much inventory was in each box. That's one way to manage your existing inventory. Another situation occurs when the company identifies that it wants to sell a new product that it has not sold before. In either case, the company identifies the need and now must formally issue a purchase requisition that details the items to be ordered. It must be signed by someone who is authorized to approve requests for merchandise. After all, if the incorrect orders are placed, it could be very costly. It could be a very costly mistake for the company. The purchase requisition is then submitted to the purchasing department, which is tasked with reviewing the items that need to be ordered and identifying a vendor to place the order with. A large company might publish an RFP or request for proposal, which means that they ask multiple vendors to submit their best offer to the company. In most cases, companies will just identify a few possible vendors and obtain a bid or place the order with an established vendor. If it is a new vendor, pricing needs to be agreed upon. Payment terms are negotiated. In addition, the company might want to closely review the vendor's reputation to ensure that they are a good vendor that the company wants to be associated with. Once these steps are completed, a purchase order can be issued, but must be signed by an authorized employee. The purchase order protects both the buyer and the seller. The purchasing company does not want to have to pay for purchases that are not authorized, and the selling company does not want the risk of not collecting undelivered merchandise. The selling company should insist on a purchase order before delivering merchandise. As part of the next step in the P2P process, the company waits for the product to arrive. In some cases, that can be a long time. And if that is the case, the company needs to manage the inventory effectively to not run out of inventory. I once worked for a company in the automotive industry, and sometimes it took over 6 months to receive car replacement parts. That is why many companies establish what is called reordering points. Let's say you sell the product on average 10 times a month, and it takes 3 months from placing the order to receiving the product. You likely want to place the order when you have about 40 items of this product left. Keep in mind that your sales quantity can vary from 1 month to the next. The customer demand could suddenly increase or decrease, and it could take longer to receive the order from the vendor. All these variations could influence how early you place the order before you actually need the products. Also, the price for a product can suddenly increase, and you need to be prepared to source from a different vendor, adjust your selling price, or come up with an alternative product. For instance, when I worked in the accounting team of Baja Fresh, there was a time when tomatoes and chicken prices increased significantly when these two items made up a significant part of the menu at Baja Fresh. Some companies even hedge this risk by participating in the futures market, kind of like an insurance policy against price fluctuations. But let's talk about the next step in the process. Once the company receives the product, a receiving report is prepared to show the quantity and condition of the goods received. The receiving report should be prepared by the receiving or shipping department, and neither the person who requested the product nor the person who placed the order should be involved in the receiving process. The purchasing department receives a copy of the receiving report and compares it to the purchase order. If there is a problem, the purchasing department will contact the vendor to resolve the problem. The accounting department receives the invoice from the vendor and compares the invoice to the purchase order to the receiving report, checks the quantities, prices, and math on the invoice, and then records the purchase as soon as the invoice is verified. The payment is then scheduled close to the due date of the invoice. I hope you found this video about the P2P process helpful and informative. Please let me know if you have any questions.